Everyone wants to know about DeFi. They see all kinds of crazy things on Twitter. You probably understand it better than most. What is DeFi, and what's happening over the last 60 days in the DeFi market?
Yeah, no, it's a great question. So DeFi is basically a way it's trying to replicate services in financial markets without the intermediary that's taking the rent or creating like some level of or like the centralized entity that's removing transparency. And so you have these issues that are kind of the similar ethos as Bitcoin. It's all under that idea. It's just more specific, more targeted. And so what's great is these aren't necessarily competing with Bitcoin. These DeFi projects aren't going to become stores of value. Their value is a function of the amount of fees and productive value they can provide. So you're starting to actually see some kind of fundamental way to think about these things. And DeFi has been around for quite some time. It hasn't really taken off until recently. So, and it existed in 2018, 2019. And over time, it's just become kind of more complex in terms of what people are building. So initially it was a lot of borrowing and lending. And so the idea was I have this money, I can post as collateral and I take a massively over collateralized loan. And now I have this capital that I can do things with. And if you think about like the smart contracts necessary to do something like that, they're a bit more simple because there's not a lot of interaction. It's the main interaction is provide collateral, withdraw other asset, and now you're out of the system. So as the development of these systems has kind of grown, the use cases have evolved with them. And so what we've seen recently was a combination of things. So, after the large sell-off in March, everything kind of bounced back. And that's when you really saw DeFi start to blow up a lot. And it was a combination of things. So on one end, you had several DeFi projects that were either launching, providing new products, V2s, updates, and trying to basically optimize their structure. And then at the same time, and this side is a bit more anecdotal, where you had some institutions come into the space that were basically almost suppressing Bitcoin volatility. So they were coming in and their whole goal was to provide yield. So they were exercising covered call strategies where they would, hold spot, sell calls, and they would just create a yield that way. And they were really agnostic to the price of Bitcoin, but more so just trying to generate a yield. And so what that would do is that would flood the market with a lot of calls. And at the same time, you'd have some market neutral desks or others that would basically buy those calls on the cheap and then sell spot to kind of offset that, to create that hedge. And so that kind of really dampened Bitcoin volatility, where we saw Bitcoin was really flat from, end of April or like May until mid to late June. And during that time, we also saw DeFi start to pick up. And so it was a really interesting combination of the two, where now you're starting to, like, Bitcoin holders are a lot of them trade leverage and use options. And so when Bitcoin is just bouncing between 92 and 96 or 97 for a month and a half, they're losing their mind. And so at the same time, they're seeing DeFi as gaining 100% a week in a bunch of these assets. And so their interests start to pour over as well. And so you started to see a lot more attention focused on the DeFi space, because that's where the returns were. And to an extent, you can think of it as like some people think of it as a bubble, but realistically, if you think about the size of DeFi right now, it's still less than Ripple or XRP. And so like, it's not a bubble in the same way that we saw 2017, where everything was running. And so you had like, billions and billions of artificial value created. Here, it's a very small set of a handful of names. And that's why at the same time, the amount of capital that flows into them causes their price to move up even further. And so what's been useful is it has brought a lot of attention to the space and created a lot of natural, I guess, demand. And so what some of these DeFi projects are creating it's intricate yield generating mechanisms. So you had the whole liquidity mining fiasco that will only continue, but like continue to improve. And so initially, liquidity mining is basically, I want you to provide liquidity for this project or basically post your assets and generate a yield. And normally the yield you'd get was a function of how much people wanted to borrow it. But now we supplement it with our token. And so the token now, users aren't getting 7-8%, they're getting 1,500% or 1,000% yield on their assets. And so
How
not
does that
only
happen? How does that happen? I think that's what people are confused by, right? They hear 1,000% yield on something and they're like, this has got to be a scam, right?
right.
So like explain how like something like that happens, and then we can talk about like yield farming and all of that.
Yeah, absolutely. So that value is annualized, and the reason it ends up ballooning is you'll have these projects that let's just say they have 1,000 tokens. They'll only distribute, a small amount at first, and it's kind of like a leaking faucet where they'll distribute that gradually. And what happens is, as those tokens get distributed, the idea is at the same time they're looking to incorporate ways that those tokens will have value in the future. And so part of those is a function of governance, and then within governance you can structure it such that a certain amount of the fees from the entire protocol go to those tokens. So what happens is they start to issue a few tokens, but those tokens start to balloon in price, and their schedule is still to distribute one token a day, but just as a scale. But that token initially started at 30 cents and now it's at $40. And so the yield has just gone insane, and like the capital you're providing is still the same. And so what happens is a lot of money floods into there because, these markets want to normalize that yield and say, I'm going to take it. And eventually they kind of come down, but for extended periods, for weeks at a time, there's people farming with like 4-digit yield, which is absurd. And obviously that's not going to be sustainable forever. But the idea there in the long run is that so the fear is, and kind of the way you can differentiate some good from some bad projects with yield farming is, okay, once that yield farming stops, what portion of these assets will actually remain with that project, and how many will just, opportunistically jump to the next situation where there's the most yield farming. And it almost makes it tough because projects won't all debut at the same time. So even if you're a project where you have a natural amount of yield that you can generate, the problem is if somebody else launches after you that can then just provide that yield, it's like, even if I like what I'm getting here and, holding all else constant, your project will generate me a higher yield, it still makes sense for me to move my assets somewhere else and capture that, and then eventually move back. And so that's kind of where the yield farming craze is happening. But it's just understanding, which projects will do the best job of retaining that capital, and then at the same time, how can they leverage that capital to generate actual fees. So not fees that are inflated by their just issuance of the token, but from providing a product that's actually useful. And so that's where things kind of get interesting, and really seeing how this whole space will shake out.